This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is a show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes, type in Old Dog, spelled D-A-W-G, find our podcast, and subscribe. Well, we've got a great guest today. This is going to be fun. Chris Prefontaine is our guest, and he is a best-selling author of the book Real Estate on Your Terms. Create continuous cash flow now without using your cash or credit, and is founder of smartrealestatecoach.com and of the Smart Real Estate Coach podcast. Chris has been in real estate for 25 plus years. His experience includes the construction of over 100 plus single family and duplex homes, mostly in the 1990s and selectively to date. Has owned a Realty Executives franchise in Massachusetts through 94 through 2000 as broker owner, which was eventually sold to Coldwell Banker in 2000. During the 2000s, he's been involved mainly in coaching $500,000 plus higher annual income realtors to scale and automate their businesses throughout U.S. and Canada. He also participated in condo conversions, multifamily homes to condos, and raised the roof projects, converting single-family ranches to colonials in growth neighborhoods. Chris has been a big advocate of education and participates regularly in high-end mastermind groups and consulting with private mentors. He runs his own buying and selling businesses with his family-operated team, participating in their own deals and completing between 2 to 5 properties monthly, so they're in the trenches every single week. Chris and his family team have done over $80 million in real estate transactions. They mentor, coach, consult, and partner with students around the country by application only, of course, to do exactly what they do. Well, Chris, welcome to the Old Dogs REI Network.
Oh, thanks a bunch. Thanks for having me on, Bill.
Well, it's a pleasure. You've got a really broad background from construction through conversions to, everything it sounds like here. So I'm real interested in hearing your story, where you came from, how you got into this crazy world of real estate investing.
Well, thank you for the intro. You did an awesome job in it, so it kind of took a lot of my wind that it didn't have to do so much work, so I appreciate that. To fill in the blanks there, you brought it through like 2000 or so, and that kind of leads me to really what we're doing now after the lovely 2008 debacle, which is, you mentioned buying and selling homes. The key there is we do that without using our own cash and without taking out bank loans and signing on those bank loans. And I learned that the hard way. So we do that every single week now. It's myself and my wife, as well as our daughter Kayla, son-in-law Zach, and my son Nick. And so each of us has a unique role. And then we have a great support team, obviously, with us as well, and continue to accumulate properties.
God, that's neat. I mean, that's a goal of mine. I would love to see my family join me. I've got a 18-year-old son right now who's going away to college, and he's buying a fourplex, living in one of the units, going to house hack and
Perfect.
start his little portfolio there. So, yeah, I'd love to hear about the family dynamics as well. Well, Chris, this sounds really neat. It sounds fascinating what you do now. When you buy the 2 to 5 properties, are you flipping them, or are you doing them on a buy and hold basis? Are you doing, lease options? What exactly are you doing with those homes that you do acquire?
Yeah, great. So we buy them all. I'll try to categorize it. We buy about 40% of our homes on, or 50% roughly on lease purchase as far as the buying in, and another, say, 30 or 40% on owner financing. And the balance will be a mix of things that come our way, like subject to existing financing. In other words, the loan stays in the seller's name. The three ways that we buy that I just mentioned, the loan never goes in our name. And if it's owner financing, it's usually because it's debt-free and we're making monthly principal-only payments, Bill. So it's a huge inflation hedge. It's a huge principal pay-down benefit. And those deals can be, most of the time, quite lucrative. On all of the exits on these, if you will, the selling in, how we move these through, you mentioned buy and hold, or what is it that we do? We put rent-to-own tenant buyers in all the homes with a game plan before doing so to get them cashed out and mortgage ready on or before the term we have set up with the seller. So at any one time, like right now, we carry around 50, 55 properties. So each month, some are coming and some are going. And that portfolio means that you get somewhere at any one time, you have somewhere around 3 or 4 million in cash outs that are scheduled over the next 1, 2, 3, 4, 5 years. And so every single time we put a deal together, we actually create 3 distinct paydays on every single house. So it's rather unique, and it accomplishes a whole bunch of things per deal.
Interesting. Now, do you have sort of a formula for those lease options in terms of the term and sort of how you structure it?
Yeah, so the typical term is 36 months, but I've seen them anywhere from 2 years to 9 years. People say 9 years. Why would a seller let you lease purchase their home for 9 years? Well, those would be people that are either upside down or leveraged fully and don't have any room for what the value is to what they owe. And so I'll even do deals with them, but we just need a lot of time. And so the market can maybe come up, but certainly the debt comes down, because over time, when we take these properties on, we are benefiting from the principal pay down, whether it's existing financing or owner financing that we create. So number wise, term wise, yeah, there's a set system, because again, we're doing it every day. So things get tweaked. You talk to a lot of people, that the business is forever changing. And so it's nice to have our finger on the pulse and be able to pass that same information, if you will, or knowledge off to our associates that we have as students.
Sure. Well, for those that don't know, could you explain what a lease option is? I mean, who actually owns that house through that lease process and so forth? Just to give a general overview.
Yeah, sure. So if I get off, if I'm assumptive at any point, you just got to slap me back into place, and I'll do that. That's a perfect question. So the lease purchase, I'll give you an example. It's always best. So let's say that I'll just use rough numbers. We get a hold of a seller that perhaps has a mortgage of $250. Home is worth $300. So let's not put it in a dire situation. It's just a situation where they couldn't sell. The homeowner keeps the loan in their name and also the deed in their name. We enter into a lease purchase contract that basically says, look, we're going to agree to pay your mortgage payment, maintain the property, and have you cashed out, in this case with $50,000 cash, on or before, let's use the term 36 months. Now, so what does that mean? Notice I didn't use the sale price. I just said roughly what he or she were thinking, $300,000, $250,000 mortgage. So we say, all right, we're going to do all that, and at the end of the term, we're handing you the $50,000 at a closing, and we're paying off your loan. Well, that loan's less than 3 years, so we benefit from that. All they want to know is, what's my cash out at the end? So the loan stays in their name, deed stays in their name. We put in the home a tenant buyer with our right to do so, and we each month collect a lease payment that's above our mortgage payment going out, of course, from our tenant buyer. We pass along any and all maintenance to the tenant buyer. So when I say to the seller, we'll take care of the home, we'll maintain it, sure, but we pass that responsibility on to our tenant buyer.
Is that just a separate expense item that they're billed for, or do you build that into the price?
Yeah, good question. You're talking about the buyer, right?
Yes.
Okay, so in the buyer lease purchase, they lock in their price for the term of the loan, and in their lease purchase agreement, it says they are responsible for all maintenance, and we get very specific, obviously, on what that means. We also get a protection from the seller on our buy end that says, look, in the first 30 days, even though you gave me a seller's disclosure, even though I trust you, obviously, I wouldn't be doing the deal with you, if something unbeknownst to both of us comes up that's over $250, you have to cover Mr. and Mrs. Seller. So the refrigerator blows up or something goes that nobody predicted in the first 30 days, we are protected from the seller. Now, we don't necessarily pass it on to our buyer, but we use it as a nice surprise. If anything ever did come up, we say to the buyer, look, we've got you covered, got the seller to cover it for you, and we take care of it.
Gotcha. Now, what's the risk on your end in these deals?
The only risk that one could say, okay, that there's a risk factor there is two things. One is if you're my seller and I contract with you to lease purchase your home, I'm going to, especially if I'm new, always make it contingent upon me finding my tenant buyer, obviously, before I take over your payments. Okay, so that mitigates that piece. The second piece that you can't mitigate other than pre-screening carefully, which we do, is once the tenant buyer's in the home, out of our, say, let's use round numbers, out of our 40 deals this year, there will be anywhere between 2 and 10% that have a life event. So there'll be between, few deals and maybe maximum 3 or 4 deals in a year where life happens. They get a divorce, a death, job change, reload, or job loss. When that happens, our contracts are set up such that we do have to maintain the mortgage payment. So what do? We refill it right away with another tenant buyer. However, when I said there's some safeguards in place, it's super important to have the systems in place that allow us to pre-screen for mortgage readiness, for credit, for cash flow, for all of that with a company that we use, so that when we're putting someone in a home, we're setting them up to succeed, not to fail. And I say that, Bill, because there are a lot, and you probably know this online, a lot of trainers openly will say, look, I do lease purchase and I don't care if the buyer gets financing. I just think morally and ethically it's a tough deal. So we don't put our buyers into homes unless we pre-screen them first and have a report with a game plan that says between this date and this date, we can get them to the finish line with financing. Super important.
Wow, that definitely is a different approach. And what would you say percentage-wise of the people that you place in there actually end up owning that house?
Yeah, it's like 95 because I leave
seriously?
that.
Wow.
Yeah, I leave that fudge factor because we have a handful each year, but the rest of them go through to the finish line.
Yeah, I've talked to folks that it's the other way around. It's
I
maybe
agree.
5%. So
Yeah, we actually have people
wow.
that seek us out. I've had this conversation many times, and they seek us out because of the family environment and the fact that we morally, ethically, and even legally really insist on having the buyers pre-screen and a game plan in place before they'll go into the home. Because you can put anyone in the home. All you got is a glorified renter if you don't do it right.
Right. Now, do you have a certain price value home that you target for these types of transactions, or are you all over the board?
Okay, this is an interesting one. So if we target areas, for example, our virtual assistants who call on homes or a mailer, that type of target, then it's like the 190 to 590 price range. And with our associates and students around the country, depending on the market, pretty similar. Now, there's exceptions, right? So we just put under agreement, finished a home inspection in our closing a few days from now on $1 million oceanfront home. Well, that's different. That just came our way from the normal lead generation. We are buying this home, Bill, side note, for principal-only payments for 4 years. It's a fantastic deal. And so we do take other deals. It's just that I don't try to target anything but the sweet spot for quick movement, and that's the 190 to 590. Now, I have an associate in D.C., and their first-time buyer range is like 7 to $1 million, and they're selling them faster than I am. So this works at every price range. It just depends on your market.
Wow. Okay, that's definitely a higher price point than most people are doing as well. So that's really interesting. Now, are these people doing the lease option because their credit is low, or they don't have a high credit score, or they have other issues that prevent them from just going through a conventional loan?
Yeah, that's a great segue from the DC issue, because people react to that usually knee jerk and they say, come on, if someone in that high price range can't afford it now, how do you think they're going to do it later? So here's the deal. You look at post 2008, let's say post 2010. Well, no secret, there's a whole bunch of people, and maybe even a lot of listeners, I know on our podcast, a lot of listeners who went through some tough times, right? And that could be they lost their executive job and now they're back on their feet. It could be that there was a divorce, and so that beat up the credit. It could be job reload, and that beat up the credit. So there's a lot of credit enhancement needed. Now, a much better buyer profile, and it does become quite prevalent as you go up in price, is, pre-2008, as you know, you could walk in a bank, I used to do it, and get what they call the stated income loan, very little documentation. Well, that's the plumber, the contractor, the real estate investor. That's all those people that used to just walk in and get a stated income loan. Now they walk in. The product exists, but it's very expensive. So now basically they walk into a bank. They hadn't bought a home since '08. They do very well cash flow wise. Let's say they are a plumber or a contractor. And the bank says, well, we don't do that anymore. You've got to actually now show 2 years of what the bank calls seasoning. And that's usually a shock to them, but they usually have 40, 50, 60 grand already put aside. They were ready to buy. So now they need the pathway of this rent-to-own program. It wasn't because of credit. It was just because the bank needs to see, again, what they call seasoning, time reporting your income the correct way. And so that's a great buyer. They just need time. They don't have to worry about credit enhancement. I love seeing those. And again, as you get into the higher price ranges, those are more prevalent.
Now, so the banker would, or the mortgage company, whoever it may be, they will look at this lease option period as it qualifies as seasoning?
Well, it's a dual purpose there. So great point. So while they're in the home, they have to now file the next 2 years of tax returns, right? So that's in a sense their seasoning. However, do they then come back to us, the underwriters, and say, I need proof of deposit, I need proof of payment every month? Yeah. So, but their main thing is that they had to get, they weren't reporting all their income, plain and simple. So now they have to report it, and they have to qualify the way they're supposed to for whatever size house they're getting into. That's really the issue. We're kind of a backup to that.
Would they be looked at as renters still as opposed to buyers?
Okay, so some loan programs now, this is also interesting as of lately, some loan programs, and we use a particular gentleman from American Financial who's had 19 years with lease purchase buyers, and they're starting to consider after 1 year those as a refi versus a new loan. As you know, those can be easier to obtain. So that's a big point. It's becoming easier and easier for them to do that.
Oh, that's great.
And the other thing, Bill, sorry, I forgot to say this earlier. Here's something real key. So it begs the question when I said that contractor comes in and says, well, I'm ready to buy. And they say, well, no, you need 2 years of seasoning. Okay, so people would say, well, why don't they just go rent then and continue saving? Okay, here's the key thing for the buyer benefit. The buyer, when they contract with us to lease purchase that home, to rent to own that home, they lock in their price. So unlike a renter, they now are developing equity in a home even though they're under a lease purchase versus just going and rent and watching the market sail right past them in some cases.
Right. Now, but generally, at least from my familiarity with lease purchases, the price that you're going to sell it to them is going to be a little bit higher than maybe market price.
A touch higher in some cases, say today. Let's say at least half the cases, it might be a touch higher premium today's number. Just told one of our students this morning. I've had one or maybe two, I told them, appraisal challenges in the last 5 years. Most of them have been coming in as recent as last week, 30, 40, 50, 180 grand higher than we had contracted them for. Now, I know the market's going to settle in some areas, but so far that's been the case. And so then people say, well, what if it doesn't appraise? Okay, well, it's a real estate deal. You go back to the drawing board and renegotiate, right?
Right. Wow. That's amazing. As far as the markets, I mean, are you pretty much anywhere in the U.S. And I don't know if Canada's included or not, but can people buy homes in any city, any metro, any state?
Yeah, they can. We've got about I called them earlier in the show associates. They're basically students that that engage with us, lock arms with us, and do deals around the country. And we've got about I'd say 25 or 27 different states covered right now. Some bigger states, we have several in one state, but we make sure they're spread out. And there's there's laws in every state, right? So like Texas, for example, you can't do a sandwich lease. You have to stick with other methods, owner financing or subject to. In North Carolina, there's a 3-day right of rescission when you do one of these type of deals like a refi. So there's caveats in each state, but that's no big deal. You can operate like this, and people have for decades and decades before me and you know?
Sure. Well, your associates, so let's say somebody comes to you and say, hey, I really want to build a business here, and I'm interested in doing this, but I don't have the cash, because it looks like they're going to need some cash up front if they're going to pull somebody out of this, the hole that they're in, right? What's your role in that?
When we buy, we don't put our cash up. Now, you brought up an interesting point. Do some people need to be dug out? Well, I mean, 1 or 2 a year comes to us whereby they need some cash to cure some arrears. And I look at it and say, well, it's worth it. There's a lot of equity on the back end. So opposite of that is what? Someone comes and says, I haven't paid my house in 6 months or 8 months. I've got 0 equity. Well, there's not much I can do or want to do with that. But for your listeners to know, especially 50 plus, I did the most recent one in my IRA, put down a $500 deposit, did catch up about $8,000 in his arrears, but my back end on that deal, which is actually closing not too distant future here, is $68,000. So he needed a bailout, and I just determined, okay, is the $8,000 or so in arrears worth picking up a whole big back end because he wanted his situation saved? Yes. However, that's the anomaly. That's not the norm. When we had our last live event last year, I said, you guys raise your hand. All the associates who've done deals, raise your hand if you put down more than, and I started the scale of $1,000 deposit, then $500, I went all the way down. Most people are putting down $10 or $100 on these lease purchase agreements, and we had, as a group in that room, over $22 million in real estate tied up. Nobody put more than that. So there's the exception that I gave you, but most of the time they're not putting cash up. And to run this business, Bill, if someone's thinking, okay, great, I can buy them, but what about running it? To run the business and not scale too crazy, but to do like 1 or 2 deals a month, which is quite lucrative, you're talking anywhere between $500 and $750 a month, not counting your website and your hosting that you may develop with our help. But that's to run your business, have a virtual assistant calling, have a little phone system that's set up virtually, have all that set up and run on autopilot. That's about what they're spending.
Wow, that's great. So you have an infrastructure in place that your associates will tap into that allows them to give that kind of leverage and that appearance, right?
Yes. So on our team, I deal with the seller side of things. My son-in-law Zach has replaced me in the buying and selling, so he handles the sellers. So if you're an associate and you call and you're just starting up, you got me one-on-one, and then once you start transitioning into scripts and how do I talk to sellers and what do I say if this happens, that's Zach. And then once you transition, now you got properties, which is the goal, and you want to sell them. My son Nick is our buyer specialist. He does all our buyers, so he's on the phone with you helping you get yours sold. And then we have the support team and my daughter and others that work on paperwork and things like that. So it's quite an infrastructure of family that, frankly, is tough to provide if you're anyone else because we happen to be doing it anyway, and we help the students do the same.
Yeah, that's great. I love that. I love that family structure. That's excellent. You've been in many different phases of real estate here, and from building from ground up, it looks like, to what you're currently doing. What would you say over those years, 25 plus years, would you say was your biggest mistake that you learned from, and you can pass that on to our listeners?
Well, painful to relive, but by far, without a doubt, it was the 2008 debacle. In fact, the first chapter, I think it's the first chapter of the intro of my book, I talk about it. I'm an open book, and the 2008 debacle was painful. It was, the run-up, too many of us thought it was never going to end, number one. And number two, my strategy back then was buy and hold, create a teeny spread monthly, but not enough to get excited about, but build on the equity in the back end. When the market lost 20, 30, in one of our markets, 70%, that philosophy of taking out bank loans, signing on commercial loans, and at the time we had 22 properties, doesn't bode too well. And so I spent from 2009 through about 2011 into 12 when I made this transition to re-engineer things, just doing workouts, short sales, working with foreclosures, working with the banks. I mean, it was a complete nightmare and waste of time. But because of that, that's what sparked, that's what the impetus was to re-engineer this business, to never ever be on a loan personally again, to find a way to buy them creatively, to find a way to have win-wins on, the buying and selling side. And that all did not exist in the debacle, and probably wouldn't have if I didn't go through the debacle. So I don't wish it away. It was a good lesson, but it was a painful one.
Sure. Well, it sounds like you're putting people more on the side of almost like the banker, where they're just collecting the money on a monthly basis from these folks, and don't really have a lot of sort of management duties, it sounds like.
No, and that is the cool thing. And here's what's really cool. I mentioned earlier 3 paydays. Now, this is great for anyone listening. The one of the things that didn't exist in '08 for me was right now cash flow. And you mentioned the subtitle of my book, that continuous cash flow, and then some kind of big back end still. So on every deal, I mentioned we do 3 paydays. Well, the 3 paydays are: I install a tenant buyer, I have a deposit up front. That's my cash. That does not go in escrow. We're not realtors. The second payday is the difference between what I'm paying the seller or their mortgage, as I mentioned earlier, and what I'm our average is around 300. It can be as high as 1,000, but we're averaging about 308 right now per month per property, and we carry 50 plus properties. And then the back end is when you cash out and you now pick up all that principal pay down benefit as well as the premium you put on the home. So all 3 paydays per deal, actual average of today's show when I'm talking to you is about 75 grand. So you just have to wait those terms out 1 to 5 years or more, and you per deal are putting that kind of money away. And the gentleman in D.C. that I mentioned earlier just did his 6th or 7th deal with us, and his 3 paydays was 107 grand. And by the way, he's a 72-year-old guy that just started with us about 7 months ago, Bill. I should have mentioned that earlier. Great story.
Neat. Well, what do you do to sort of hedge against the capital gains on those big paydays?
So on capital gains, you have 2 choices. It's going to be your accountant's choice on this. But with the lease option, by nature of the way we sell and rent to own, you will come up with a formula with your accountant because you are not required to report that as income until such time the option is exercised, i.e. they cash out at the end and they close, or they default. So when you bring in that average deposit for us on payday 1 is like 27 grand. So when you bring in, let's say 25 grand, you can, whatever you come up with for a formula with your accountant, so you don't want to get whacked all these at the end. We tend to do about 50% now and 50% at cash out. Other people say, given the situation, they can wait until the very end. But you're not required to, per the guidelines, until such time it's exercised or defaulted.
Okay. Great. Well, I talked about the biggest mistake. What would you say, conversely, is your biggest success so far?
Well, frankly, it's the re-engineering and the building with the family of what we have today, because to set that kind of an infrastructure up inside of, for the listeners to put a time frame to this, for listeners to say, okay, inside of 18 months, let's say we had that up and running fully with 20 some odd properties running in the inventory waiting to be cashed out. Well, you're talking about, it's over $1 million. So to set that up in that short a time frame, that was by far our biggest win, and then continues obviously to be as we scale it. But to re-engineer that, get that back on track, and not have the exposure, put the head down on the pillow at night, not worry about it, that's huge. That's
great. Well, you talked about the 70-plus year-old guy that got started doing this. We have a lot of folks listening, 50 years and older. Some are approaching retirement, some are already there, and they're really looking at cash flow. They're looking at, how am I going to fill this gap of where I am or where I think I'm going to be and where I want to be. And what would be your advice to those folks that are approaching this challenge right now?
Well, I'm biased to this method, right? So you take him as the example, and we have many, but he's a great example for this show, as well as myself. I'm 20 years his junior, and I'm still thinking the same way, and that is, I need cash now. I need ongoing to sustain my lifestyle, and I need some cash outs down the road that you could call that retirement if you wanted to. And here's the cool thing for the listeners. Let's say someone says, look, I don't need more than 6 deals a year, the way you said that, Chris. Okay, we'll go out, we'll show you how to do 6 deals. Take 6 months off if you want. Those deals aren't going to stop. Those 3 paydays are still going to be generating. And then if you want to go back on the horse and create some more deals, you can. Now, he happens to be going very aggressively, and he gets excited. And as he told me, he feels younger than he was 20 years ago just by the system that we've got him on. But heck, they can do it at their pace, take a break at their pace. And I think that's what a lot of people are looking for.
And what does it take for a guy to get started doing this?
If they wanted to look at our webinar, it's free. You can go through our webinar and see kind of what does this business look like. If they were to go forward, they're going to have to budget in their mind. I said that 5 to 7. Just figure $1,000 a month. But keep in mind, after 90 days, some people 30, but I'm saying between 90 and 180, they'll be cash flowing already. So just budget 4 to 6 months maybe of some outgo before they start cranking in these deals. And I don't want to candy coat it, but there's a police officer in Pennsylvania that did do it, his first deal in 30 days. Well, that's kind of neat. You didn't get any bills yet, and you did your first deal. But that's, you got to figure 6 months to be safe. Gotcha.
You sound like you've had such a broad spectrum of involvement in real estate. It sounds like you already crossed the 50 mark, so you qualify, whether you like it or not, an old dog status. You don't look it. I see your picture. You look like you're 20 something.
Thank you. You'd be my new friend. I got to put you on the computer.
But where do you see, where do you want to be in 10, 20 years down the road for your business, your family, and so forth?
My wife jokes, and I don't actually consider this work. I love creating deals. The deals don't change, so I don't see myself doing anything differently. I do see myself being pickier. I've been able to replace myself with the kids in the business. I know a lot of people would be interested in how to do that and how quickly to do that, so we train on that. And then I think down the road, what'll happen is, it's already in place, is my son-in-law will then replace himself as I did with him, so that he can free himself up for more coaching with me and helping the students out. So we're going to continue doing what we're doing. The way we've got it structured, you can put it on autopilot and help a whole bunch of sellers and a whole bunch of buyers feel real good about what they're doing. So it's neat. And the day I'm bored, Bill, is the day I'm stopping. But right now, the deals are always changing. As you know, there's no one deal. Despite any formula I can give you, there's no one deal that's the same, and it keeps everything fresh.
Okay, that's great. Well, it's a big part of the folks that listen here too. Many of them want to be able to leave that legacy to their kids and their grandkids, and sounds like you set that up, which is really, really exciting. That's neat.
Yeah, you know what else, Bill, too? I should have said this when you talked about the audience. They can and should know that, as I alluded to earlier, they should be doing this unless they need to fix cash flow first, which is great, but then they can do it, and that is in their IRA, and self-directed IRA or other vehicle, because I want you to picture what I said earlier. You put, in my case on that house, I broke the rule and put 500 down instead of 100 or 10, but that 500 turned into 68 some odd thousand inside of a 36-month term. So super important for people to know that as well, depending on where they are with their planning.
Yeah, that's neat. Gosh, there's so many more questions I have here, but unfortunately we're kind of under the clock here. But working with your family, I mean, that to me is so the pinnacle. That would be awesome to have my kids involved and be able to help them in growing their careers and their lives. And what's that like, working so closely with your family?
Well, there's obviously a cool trust factor, but I've heard the kids say this, and I've heard others say this, that, look, everyone doesn't want to necessarily work with the family. I do, and we all love it. I like the trust factor. I like the predictability. Good for people to know the way we built this is we are all really, with few exceptions, on a per deal basis. So everyone is on the same train. Everyone wants the next deal closed. Everyone wants to help the next student make their deal closed. So we're all on the same page. That's pretty cool. And the last piece, and I guess it's not just that's not related to family, it's related to the structure we built and that we help others build, and that is the predictability. I think it's super over the top important for your listeners to know that there is predictability in this. I mean, they'll see it in the free webinar, Bill, but they can dial this down to, all right, Chris, tell me how many properties how many owners I have to talk to get a deal, and then how much is that deal worth, as we already kind of talked about. I mean, it's that predictable. I'm a numbers person. I want predictability. I want to put my head on the pillow at night saying, I know if we hit our targets next week, it means X, Y, and Z, period. And so I love the predictability of the whole system.
Well, yeah, I would imagine too. With your family members, they wouldn't do it unless it was, there was good prospect for wealth creation in their own lives, right?
Absolutely.
So that's pretty neat. When they can see it, they can experience it and live it. That's great. I mean, whether people are building up a rental portfolio or whether they're setting up a program like yours, I love that idea of being able to, make it something that the family can get involved with and/or hand down to them.
Well, it goes deeper on that note. I set up, we have a grandson just 5 months, and I set up a self-directed Coverdell in his name. And so what does it take? It takes a few deals, and then the education's done. I mean, just think of that. And then you get generations of tax-free income there.
And that's great because, that's one of the things that a lot of folks that I interact with on a daily basis have shared is the fact that, hey, I've got a son that's trying to finish medical school and I want to be able to help him. Or I've got 3 unmarried daughters, as in my case here.
There you go.
Yeah, that I've got weddings and, I want to be able to offer them their dream wedding and maybe even help them with their first house purchase, or whatever. To be able to see that and to be able to see the fruit of their labors here come through this family business is pretty exciting. That's neat. Well, we are almost out of time here. We have a session, we call it our Wrap It Up. This is where I ask you a series of quick questions and you give us resources that you tap into, share it with our listeners that they can access. After that, we'll go ahead and move on to some final questions here. But if you are ready, we'll go ahead and do the Wrap It Up.
Yeah, let's go.
Favorite real estate book?
Recent, it was Sam Zell, speaking about real estate. I think it's Am I Subtle or Am I Being Too Subtle? But he's just a hoot, and his book's amazing. And my answer is going to vary every week, depending on what book I'm on. But he was the most recent real estate one that I enjoyed.
I just heard that one, just recently. So I gotta read it. I haven't read it yet.
Fun
That's
book.
Great. Awesome. How about favorite business book?
I picked this up on my podcast, and I forget who I was interviewing. He gave me this one, and I'm almost done. It's fantastic. It's called The Hard Things About the Hard Things, Ben Horowitz. And he does not say, here's ABC formula. He says, look, this is the crap hole that I got into when I was building this massive company, and here's what I did to get out of it, and here's what it's just a great, great book. It's just a hard truth.
Oh, I love it. That's great. Another one I'll put on my list.
Yeah.
How about most valuable website for success?
We tend to, again, it's like the book answer. I know this is rapid fire, but I tend to just go with whatever's my newest thing I'm working on. And right now I stumbled upon getleverage.com. Heard about it on someone else's podcast. It's an outsourcing, it's not a VA, it's an outsourcing company that basically does anything that's legal, as they say it. And I've now got about 12 projects going on with them. So I just leverage the daylights out of myself, and it's getleverage.com. We always list it on our resource area too, but it's a fantastic site.
Oh man, you got my curiosity going on that one.
Oh, it's awesome.
It sounds neat. How about favorite app?
I'm not big on the iPhones or the apps, but the two that came to mind when you said that would be, I use a Calm app, CALM, for meditation in the morning, just to kind of center and start the day as one of my rituals. Not every day, but when I do, I use the app. And then Telegram. We use Telegram with our teams. We use it with our marketing team that's out in Canada. We use it internally here at Telegram. It's a great little communication app.
What does that do? I've never heard of that one.
It's like a private app for each of you to communicate. So it's like you're texting someone, but it's on an app. You're not getting blown up with text messages. And it's just, say, your team is, say, there's 4 of you on there, and so you're each talking. It's like a live chat. So we update each other on that with more urgent things, and then you're not going into email.
Neat.
Yeah.
Okay, here we go. This is the big apocalyptic question here. If you lost absolutely everything, I mean, just boom, houses, cars, everything, and all you had was $1,000 in cash, what would you do with that $1,000 to rebuild your business?
No matter what amount you said, or even if you said 0 or $1 million, I give you the same answer, and that is find a mentor that is doing what you want to do, not used to, but is doing what you want to do. Find a niche that you want to be in, find the personality that you can connect with, that's important, and then to hang on to their shirt tails. There's a way to do it. You call up authors, or you write to an author, or you find a coach, they'd be more than willing to help you, and there's no other way to do it. Find someone that did it. Success leaves clues.
That's great. You've sparked a lot of questions for the folks that we have. How can people reach you? You mentioned this webinar. Where do we have to go to find out more about you and what you do?
Well, I'll give you my email, but the webinar, so I don't leave that hanging, is it's free. It's content driven. It's the new one's about to be posted. Just go to smartrealestatecoach.com, smartrealestatecoach.com, and you can opt in for the webinar. My email is simply Chris, CHRIS, at smartrealestatecoach.com. Might want to just put in the subject line that on the Old Dog Show or something, so I know where you came from and I can help you out. And then you mentioned, Bill, the podcast, very similar, smartrealestatecoachpodcast.com, and I'd be happy to help.
That's great. That's great. Well, I definitely pick up the Bostonian accent there. That's smart.
You bet.
That's great. I love it. Gosh, I can't thank you enough, Chris. This has been so helpful. Just a pack full of info, and hopefully they'll be able to supplement that through your website and your podcast as well. Before I go here, actually, we do have a tradition here that I can't ignore, and if you know about the show, you know that you can't escape this one either, and that is all of our guests close us out with their best old hound dog howl. I don't think New England has many hound dogs, but you got to have some reference here that you can just give us your best howl to close out our show with.
Well, and I saw that on the notes from our assistant, so I did some prepping for you. I actually had to look up what the heck you were talking about and did some prepping for you. And in the light of that website you asked me about, I did some homework and actually did rehearse for you. See, I told you I rehearsed for you.
I don't know. I kind of think that one might have been, I don't know, either you had your dog on mic or pre-recorded.
Well, I said in the light of Get Leverage, we needed to make sure we outsource this stuff and do the best we can.
So that was a VA, huh?
That was an outsource.
From Pakistan.
There's a takeaway for everyone from Get Leverage.
I love it. Okay. Well, Chris, thank you so much for being on. We really enjoyed it, and I'm excited to hear how our audience reacts.
No, same here. I'm happy to help. Thanks for having me on, and I'm happy to respond to anyone that takes a few minutes to email. Thanks again, Bill.
Great. Well, it's my pleasure. And I also want to just thank all our Old Dog listeners out there for joining us today. I know there's a lot of other things you could be doing, but the fact that you've taken the time to join us means a lot, and we greatly appreciate it. Please note, Old Dog listeners, everything presented here today, including the links in the Wrap It Up session, as well as all notes on everything that Chris talked about, can be accessed in our detailed show notes on the Old Dogs website at olddogsreinetwork.com/blog. And look for the episode with Chris Prefontaine. Well, that's the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward, and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.